Welcome, everyone, to the Financial Advisors Want to Know podcast. I'm Catherine Tyndall, a CPA here at Dominion. We're a specialty tax and accounting firm that works with financial advisors for their own practices, making sure that their tax planning and compliance is on point. And today's episode, we have Scott Schweiger, who's also a CPA, has his own practice with a decade of experience assisting small businesses and their owners navigate the complex and continuing to get complex accounting and tax landscape. He's found success from the drive to figure out how things work and his desire to just be useful. How this conversation got started was Scott and I were talking about a very common issue that we've encountered for financial advisors who are looking to do tax planning, in particular with S corporations. So today's episode is when S corporations can be a problem, because a lot of times they're sold as a cure-all for tax planning, especially for trying to save on self-employment taxes, but that is not always the case. So welcome, Scott. Thanks for joining me today.
Hi, thanks for having me. Pleasure.
So I figured we could jump right into talking about the particular court case that we were discussing previously. This is the Fleischer case. This happened a number of years ago, and it was a tax court case involving a financial advisor. I can give some background on it, or would you like to, Scott?
I can give the very high level if we want to get through that.
Yeah, let's do it.
Basically, what happened is the IRS came in on a random audit. They noticed a 1099 mismatch between claiming income attributed to the individual that was claimed through his S corporation, and they decided to dig further. When it came down to it, they took it to tax court, and the tax court decided, yep, that wasn't the S corp's income, that was yours, and there's taxes and penalties ensue.
And I think for him, and this is probably true for a lot of people, they don't realize that when you're trying to do the S corporation status to save self-employed taxes, which is a really common mechanism that usually works for people, there's specific issues that advisors can run into specifically because of their regulatory requirements. And for him, that was the core problem of what was going on, where he had created this S corporation to try to, pay himself a lower wage so he wasn't getting hit with the self-employed tax that you would get hit with as 1099 Schedule C. But he didn't have any agreements in place with his broker dealer or his insurance company with his entity. And so at the end of the year, the broker dealer and insurance companies would issue 1099s to him personally. And then what he would do is wipe that off of the Schedule C and then reallocate that income over to the S corporation to then have it flow through that way. And I think that is really at the crux of the issue, is that because the entity didn't have the control over the income, and that he wasn't in fact really an employee of the entity in that same way, that a normal person would be. That's why they disallowed that kind of a treatment. And I think on top of that, the fact that they took this all the way to tax court was to get that precedent to disallow that kind of treatment. And so since we don't need to get too in the weeds on the case itself, and I want to talk about, okay, so if you're an advisor with an S corporation, or you're an advisor thinking about getting an S corporation, what are the pieces that you have to be worried about? The first thing that's the takeaway from this case is you really have to make sure that you're getting agreements. You're going to be able to get an agreement between the entity that you're going to be creating, or the entity that you have, and the broker dealers or insurance companies that are issuing you the payments, and that those payments are going in to the bank account of the business, and that the agreements are with those businesses. What are some other things that people should be thinking about when they go to have an S corporation in this kind of a structure?
Yeah, I think kind of to echo on what you were saying, the contract and the timing is definitely a thing. That was something that Fleischer didn't really do. We actually signed the contract and then created the S corp, which is the wrong way to do it. So go in eyes wide open. Can I have a contract with the company versus myself? That was like a key piece. The other point is, treat it like a business. He had I kind of tell clients all the time, just make it match real life. That's all we're really trying to do. If the money comes to you personally and it avoids the business, that's a problem. So you need to have the money flow match what you're trying to do. Case in point, if they're paying it out to him personally, you need to at least, at minimum, to try to even mount a defense, is get it in through the business bank account.
Yeah.
And
exactly.
It's kind of like, it seems silly sometimes when we say just make it match real life, but so many times it comes down to, well, why didn't they agree? Well, because you didn't do the thing you claimed.
Yeah, exactly. And for them, a lot of the times in these altercations with the IRS, you can do fancy footwork with your paperwork, but they want to know what the economic substance of what's going on makes sense. And that's what they're interested in. And that's what happened in this case. And in particular for this advisor, and I think for many, the reason why that wasn't shifted around is because of the FINRA requirements, because he wasn't able to get it attributed to the entity for some of the sources of income that he had. And so I had this situation come up recently for a client who's thinking about, she's with LPL, who is the same,
the same one,
the same as in the case. And basically, they are able to attribute some of the income over to an entity and have an operating agreement, but they're not able to do that for all of the income. And so for instance, with the brokerage income, they can't reassign that to the entity. It has to go to the license holder. And so that income is always going to be apportioned to my client on a 1099 and not available to go into an S corporation. And so that's a good thing to know before you go into that kind of arrangement, because for her, the S corporation makes sense because of business transition reasons. But for some people where they're considering the S corporation, particularly for a tax saving mechanism, that could just shoot you out from actually getting a real tax benefit from it if the bulk of your income is going through that 1099 to you personally. Now, something that you might want to consider is, well, if you have to take that kind of a treatment, then maybe, considering something like going, the RIA option, where you're going to be able to get you have to file the paperwork to do it, but the RIA can have the agreements with these different companies to get the funds in. And so you can take higher advantage of that S corp than you could if you were just a solo individual. So that's something that you want to do the math on and figure out, okay, well, if I'm going to do this and do this right, maybe it actually makes more sense for me to pursue the RIA thing, because I'll be able to really yield a high return on the tax savings by doing the S corporation. In particular, right now with where we've got the pass-through entity tax workarounds for a lot of states where you're not going to be able to get that as a sole proprietor, but if you're able to shift into an S corporation, you can take advantage of those pass-through entity tax deductions and not get hit with the SALT cap. Now, this is something where that's potentially up for change, right? Because the tax law that has that enforced,
is coming down.
2025. That's a provision that's sunsetting, and so that's going to be another big piece of what's on the pipeline for people of, we're probably going to see some significant changes in the tax landscape over the next 2 years. And especially we're going to see a lot of crazy proposals that come out that maybe go nowhere. But keeping that in mind of, okay, maybe after, the TCJA sunsets in 2025, we need to reassess what kind of entity we are. But for people who are in S corporations and who think that they might be in violation of this, it's something that the IRS, they're increasing their enforcement budget. And if you're not in compliance, they're going to be able to come back for multiple years. And that's what they did in this case, where they ended up coming back for many years in a row. Part of the issue too, in this case, which is definitely worth mentioning, is that the advisor was paying himself a pretty low wage compared to what he was taking in distributions. And that's another core piece that a lot of people don't realize when they get into S corporations, is that you need to be paying yourself a reasonable compensation. And that's not just a number you pick out of a hat, that there's methodologies that the IRS wants to see on that. And that could be a whole other episode, is how to do reasonable compensation. But it's not just as simple as filing for an entity and then shuffling things out on the return. What do you think, Scott, about, other issues related that you've seen with people in S corporations, and in particular for, advisors who are trying to do like entity tax planning?
I will definitely say do a whole episode on the reasonable comp for an S corporation. That one is not just financial advisor related. Everybody getting into the S corp needs to know that you need to do a reasonable wage, and it's even harder for these single member S corps, because what's a reasonable wage when you ostensibly are the only employee? So what else is driving your income? So that becomes an issue.
Yeah, and that's definitely part of the. Oh, go ahead.
I do have a client who. It was actually a group of advisors, and they were kind of sick of their treatment and everything. So they created their own RIA with the idea that business then contracts out to all the other advisors. So you have this whole web of S corps. But they went into it, seeing some of the pitfalls, getting everything in place, getting the contracts in place, making sure that the money's flowing in the right way so that they all can take advantage of their the S corp status and that self-employment tax savings. Now, what each one of them does with the reasonable comp is up to between them and their individual tax guy. So,
but I think that's a really good point that, I think people don't realize, a lot of advisors don't realize that you can get into really creative entity structures, You just have to plot it out, and it has to mimic reality. And the structure that you're mentioning is one that I encounter all the time, where you've got that RIA sitting at the top. That's the one that's kind of taking all the funds in. And then there's a lot of control at that level, how things are going out to the different S corporations. And then when you have different things, right? Like, somebody on the team is going into semi-retirement. Somebody in the team is, lowering their participation, or maybe they're going to shuffle some of their book over to one of the other, advisors. By having these more nuanced structures, it allows you for more flexibility with those things, where you're not going to get in trouble with the IRS because you can pre-plan it and then have it mimic reality, with how the money is flowing through the different businesses, how people are getting compensated, how you're running payroll, all those sorts of things. It's important to, do those structures out. And if you're going to have a complex structure, have your org chart and have all of that where it's obvious what's going on, and that the money and what's going on in your QuickBooks accounts, or however you're doing your record keeping, is matching kind of that bigger, organizational structure in a way that it's working like a business.
And you have all these entities who can work together too. So if you have admin staff, they can be up here, and it can be a least cost for each S corp down the line. So all of a sudden you're not the sole driver because you have other labor costs, which is a good fact pattern to have.
Yeah, absolutely. And then you can have those conversations with the other partners, partners in the S corp, returns are kind of the partners. You can have those conversations and control the allocations of what's going on at an expense level when you have that overarching partnership, where, if you were just one single S corp entity, and it makes it harder to do more of that kind of special allocation work.
Just got to be strategic.
Yeah, it has to be planned out.
Yep.
And it has to be, you have to have that plan, have the documentation, put things in writing, and then execute according to what you've agreed with the other members in your group of. And then two, there's ways that, you can have these kinds of relationships where maybe you want to bring some on and have them work with you a little bit, but you don't fold them up into your entity structure yet, or, finding other arrangements for things with, maybe you're just going to be sharing some branding, but they're not actually using your licensing or your platforms yet, but you want to share some office space and you want to share some branding. You don't necessarily need to be in the same entity to get that done. There's other ways that you can structure these things. But I think the big takeaway from this case for me, as we wrap up here, is really, you can't, when you're going to do tax planning, it's not as simple as just filing an election and shifting things around on the tax returns after the fact. That real tax planning has to happen in real life, and it has to mimic, like you said, like normal activities. It has to be like real life, and that it's behavioral changes. And that's what the IRS wants to see, because if it's just paperwork changes, you can run into some serious trouble. And when they have, typically when they come in on these audits, they're not just going to look at 1 year by itself. If they see habitual behavior that's happening, they're going to pull in as many returns as they can under the statute of limitations and get you on it. That's typically how they work. It's going to be these bulk audits. And so if you're running afoul of them, you might have a couple of years where you don't hear anything. And then all of a sudden you're doing some behavior that's going to get triggered in their system, because they're going to see, oh, there's this C, the Schedule C that keeps getting zeroed out, but we only see 1099s attributed to this Social Security number. This doesn't make sense that this is getting zeroed out every time, right, from their computer analytics. So you really can't get away with it, so to speak, because their computers are going to be looking for this kind of behavior, especially where they took this to court and they know that it's going to be, it's an area that some people are not being compliant and trying to skip out on Social Security tax beyond what they should be doing, through doing things in the normal pathways. So I think that's all important things for people to consider here. But any other closing thoughts from you, Scott, before we wrap up?
Yeah, I mean, it's pretty simple. Be proactive with your timing and setting up your LLC. Make sure you know what your regulatory limitations are. Make sure your contracts are in place for obligations and who gets what. Follow the money, and make sure your 1099s to the appropriate entity. I mean, those are really the big key points.
Yeah, no, that's great. Awesome. Well, thanks for joining me, Scott. And for people listening, there'll be links floating around wherever you engaged with this for how to get in touch with either of us and how to learn more about some of these issues. Stay tuned for a future episode on reasonable compensation issues, though, because that's a nice meaty topic in and of itself. But thanks again for joining me. I appreciate it.
Yeah, thanks for having me.